Come on.
Hi.
Hey, how are you?
I'm good. I'm excited.
Wow,
To get started. Yeah, we had some people calling and
awesome.
yeah. David, should I pause recording for now? You're muted. Yes. Okay.
And hold, and that would allow you to hold that rate 120 days before. Now, if you are concerned and there's always the ability to do a cost benefit analysis. We can always look at the cost associated with maybe doing the renewal now. That may require a small penalty, but if we can outweigh sort of the cost of the penalty with the interest savings, it may make sense to do that now versus waiting. So you don't necessarily have to wait. There are options available to you, but we also have the ability, depending on where in the fall your renewal date is sitting, to potentially lock you in today.
Got it. And do we expect that it's going to be getting worse, or it definitely won't come down, I guess, come the fall?
So I think
is your advice, yeah.
So again, as I go through the presentation, I'm going to draw reference to where rates were sitting historically. So I think the one piece that I just want to communicate today is that I'm going to be working with facts. I wish I had a crystal ball and I wish I could predict the future for clients, but unfortunately I can't. I think that if I had to wager bets, leading back to 2019 or early 2020, that we would be in the current set of circumstances, I would have lost, right? So I think for me, we need to focus on facts. And the facts are the economy is rebounding, that we were sitting with historically low interest rates, and that it was inevitable that rates were going to increase. And if we look at trajectory of rates in terms of where they were sitting in 2017 and 2018, we're not that far off the mark today. So I think it's important to understand where rates are sitting today, that, as things continue to rebound and improve, that rates are going to increase. We're seeing inflation, we're seeing the economy begin to rebound. So I think it's inevitable rates are going to increase, but there are options available to clients. There are rate specials being offered by lenders, and there's the opportunity again to lock in now and continue to just track. Like, we can hold a rate today and continue to track where rates are going and have you lock in or commit closer to your actual renewal date. We can look at the option of potentially taking on a penalty and having you do that today, if that will help, ensure peace of mind. And we can ensure that we're then working with you in your affordability so that you feel in the driver's seat on that decision moving forward. Is that helpful?
Right. Very helpful.
Good.
I have another question.
Sure.
Okay. So I'm not sure. I've never had to renew, actually. So this will be my first time. Your current lender will offer you a renewal and you don't have to go through the whole process.
Mm-hmm.
And my understanding is if you go with a new lender, I guess, like speaking through a broker, you have to go through the whole process again. Does that typically yield a better mortgage?
Possibly.
Because to me, it's kind of weird that if your house goes up in value, if your income's increased, they don't look at that. They would just kind of like roll you into a new mortgage. It seems odd to me. Or am I misunderstanding and they do look at all of those factors?
So your current lender will offer you an auto renewal rate. So if you're not looking to increase the mortgage amount and you're looking to simply renew for another 5 years or an extended term, the lender is going to simply make an offer on rate, both on the variable as well as the fixed, and give you the ability to select your term. So you can opt for a 5-year, a 10-year, a 3-year, whatever is best suited for your needs. And that will be an automatic. And you are correct in your assumption that does not require submission of any documentation. It's an auto renewal option that is made available to you. If the intention is to ensure that you are getting the lowest market rate, it's great to check in with a broker. We have access to multiple lenders, over 40 lenders. It gives us the ability to validate that you are getting the best rate on market Should we decide that we need to move your mortgage to another lender to get you that lower rate, then yes, that does require submission of information such as your income, property details, because that new lender doesn't have any of your details. They need that to ensure that you have the ability to carry that mortgage and make your payments. So that does require submission of updated information at that time.
Got it. Thank you.
It would seem though, if the property's gone up in value and you've had some increases in income, that you likely would be in a better position. So hopefully the new lender would be able to take a look at all of those documents and make a, pretty good educated decision based on what you've already been paying too, right?
Correct.
Okay, cool. Awesome. Well, should we get started, guys? I think there'll be probably some other people popping in. So, before we hand it over to Rakhee to kind of share her screen and go through a presentation, I just wanted to say thank you so much. We're really excited to have everyone here joining us for our Homeplicity Realty Group interest rate with Mortgage Savvy. I know that you guys have heard Rakhee having some discussions and just sharing her expertise. So we are very grateful for you guys to come and invest your time with us, as well as for Rakhee to come on and share her expertise. We've been working with Rakhee and partnering with her, helping our clients secure the best mortgage rates for years. Rakhee is—
some of these people, I think, use her.
Yeah. So we have some joint clients on here, which is amazing. And Rakhee, in case you don't know, is an award-winning mortgage broker. She's the CEO of Mortgage Savvy. And not only is she a wonderful person, but she's very, very skilled at what she does. And we know that our clients are in good hands when we refer them to her. So without further ado, Rakhee, we would love if you could share your slide deck with us.
Absolutely. And thank you, Stephanie, for that warm introduction.
Can't say enough good things. And feel free, guys, if you have questions, to pipe in or to type into the chat box, and we'll do our best to make sure that everyone's questions get answered.
Perfect. So I'm going to encourage everybody to use the chat box. I know everybody has burning questions, and a lot of these questions are going to be very specific to your set of circumstances. So I'm going to do a run through of the presentation and then happy to address your specific questions as well. So top of mind right now with respect to anything that we're seeing in the media is mortgage rates, right? The recent Bank of Canada announcement on April 13th, where we saw an increase to the overnight lending rate, which took the prime lending rate up by 50 basis points. So that was the first time we had seen an increase of that size in over 22 years. So it's completely natural that we're all kind of taken back a little bit. We're all wondering, how is this going to impact us? And so I think it's important to lead with facts, and hopefully I can walk you through the process of what this may potentially mean to your current financing, what it may mean for a potential renewal coming up, or if you're just contemplating, how do I decide what is the best product for my specific needs? So I'm hoping I can walk you through some of the facts and help guide those decisions for you. So a little bit about me. So Stephanie, thank you so much for sharing. So my focus with Mortgage Savvy and establishing Mortgage Savvy has really been empowering clients with financial literacy. So it's the education piece that removes that sense of anxiety or uncertainty. So happy to address any of your questions along the way. And please take the opportunity to utilize the chat as well. So
Rakhee, I don't think your slides are showing, by the way.
No.
No, it's just saying like Rakhee's sharing her screen. I don't know whether it's a setting on yours.
Let me try this again.
Let's just try again.
Okay.
It was working before.
Do you see it now?
No.
That is strange. Okay, let me try this one more time. It was working perfectly.
Are you on that screen?
Mm-hmm.
There it is.
Okay. Third time's the charm.
Success.
Okay, So we started to see rates rise. The first increase to the prime rate was in March, where we saw a 1/4 point increase to the rate. And then subsequently, we saw another increase on April 13th, which took effect April 14th. So anybody that was in or is in a variable rate mortgage product immediately saw a rise to their interest rates. Or if you currently have a home equity line of credit, you also immediately saw an increase to the overall rate you were paying on your facility, which is going to impact your minimum payment requirements. So on the mortgage piece, every lender addresses that a little bit differently. And as we work through, the presentation, I'll address how lenders, address the change to rates and what that means to you in terms of your payment obligations. But with respect to anybody that has a current line of credit or a home equity line of credit, it's important to be mindful of the new interest rate that you're paying on that facility and what that means in terms of your minimum payment requirements as well. So I think there's also a lot of uncertainty. We're all kind of hoping that we can predict what's going to happen in the future. And I think that's difficult for anybody. I think economists, financial professionals, these are very unique set of circumstances that we're all finding ourselves in. So we're doing our best to educate, work with facts, kind of lean on history and guide you in making the best decision for you. And the one burning question is, do I go fixed or do I go variable? And this is definitely a question that I personally like to shy away from. But I think it's important to give clients a little bit of perspective. So I'm going to share my personal story with you as well in terms of the decisions I've made for me. And hopefully that process is going to give you a little bit of an education to help you make some, potential decisions for yourself.
Why do you like to shy away from this one?
It's because there's an element of uncertainty, and two, everybody's set of circumstances are going to be unique. And it's important that we're matching the product with the client's needs and affordability and risk tolerance. Because with a variable rate mortgage, those that are paying attention to mortgage rates, variable rates sit significantly lower than where fixed rates are sitting today. But the reason for that is because you're taking on an onus of risk. There's upfront interest savings, but there's a question mark in terms of what will be in the future. And it's important that everybody's set of circumstances are different. I might be a little bit more tolerable to that risk, but someone else may not be. So the answer for each individual is going to be very different.
Makes sense. I always like variable because I feel like the time frame or the years that I'm paying less interest, even if it goes up, I'm still less, but I feel like I have savings. Like historically, when I've taken a look at my mortgage, but my last mortgage I did have a fixed rate, and I regretted it. But I think, as you said, it's different for everyone, your risk tolerance, the circumstances, what's happening in the market.
And what's important to each individual is different. And I would agree, historically, the variable rate has saved Canadians more interest and helps you pay down your mortgage faster. And I think that's a great sort of, point that's made. Unfortunately, mortgages in Canada work very different than they do in the US and in other countries. And here in Canada, you need to narrow that focus. We're holding a rate, the most aggressive rates that are offered on a 5-year term. So we really need to narrow our time horizon, right? The rate you're selecting today is a rate you're going to be able to hold for that 5-year period. So when we're comparing fixed versus variable, what I encourage clients to do is really narrow in on the 5 years. It's inevitable in 5+ years, we're going to be in a higher rate environment. Just, something that we're going to continue to see. So what can we do today to better position ourselves? What can we do today to position ourselves with a lower principal mortgage balance? So we have less to renew at the end of that 5-year term.
Yeah.
So the one point that I do also want to draw some reference to is, given inflation, the Bank of Canada is making these decisions to increase the prime rate to ensure that we're in a more stable economic environment. And so there is a range, there is a neutral range, there's a target range that the Bank of Canada is aiming for. Ideally, they would like to see the prime rate between 4.2 and 5.2%. Now, there is a little bit of a question mark there. We don't necessarily have a timeline or a specific timeline as to when they're anticipating us reaching that range. Now, given the increase on April 13th, prime is currently sitting at 3.2%. And
Sorry.
Yes.
When you said about the 5.2, but we're all still qualifying at 5.25, right?
Yes, that's the benchmark rate. This is where prime rate is sitting. So this is very different than what we're qualifying. The stress test rate is a separate sort of equation. This is really just where ideally to offset inflation, where the Bank of Canada wants to see the prime rate sit. Right now it's reflecting at 3.2, but eventually the goal, the neutral range is between 4.2 and 5.2%. So when I'm looking at my personal mortgage, I've made the decision to stay variable. And this is where I'm going to kind of walk you through my thought process and how I made that decision. So with prime sitting at 3.2, anybody that secured a mortgage over the last few years is probably looking at least a discount on their variable rate of prime -1. And I know personally for a number of clients, I've been able to secure even more aggressive discounts. But I'm kind of using my example, my personal mortgage, I was able to secure a rate of prime -1. Prime sitting at 3.2, -1 is a rate of 2.2%. So I'm very comfortable holding on to that rate, knowing that prime is at 3.2. What that means is in order to get into that neutral range, over the next few years, we are going to see anywhere between 4 and 8 increases to quarter point increases to the prime rate. Now that's going to be an eventual process. I now have the ability to secure that lower, keep that lower rate, increase my payments to put more towards paying down my mortgage. And given that fixed rates are sitting between 3.89 and 4%, I'm going to comfortably stay where I am, knowing that I have the interest savings on the front end of my mortgage, and I'm going to pay it down as quickly as I possible. I'm going to put some strategies into place to offset that increase to interest that I may see later, because it would take 7 to 8 increases before it made sense for me to lock in on a fixed.
Mhm.
So everybody's set of circumstances are going to be different, but going through the process of running these numbers and ensuring that we're really stepping aside to look at the facts. Yes, are rates going to increase? Absolutely. The trajectory of when that will happen is uncertain. Now,
the free money era is over, right?
Yes, yes. And I think that anybody that did secure a variable rate over the last few years, I think we all did so with the understanding that rates were going to eventually go up, that we were sitting on, the opportunity for free money. Absolutely. And it wasn't realistic for us to assume that that would be sustainable. So rates are inevitably going to continue to rise. And I think it's important that clients put strategies in place to really address their debt. When rates were sitting low, we were encouraging clients to accelerate their payments, to really focus and sort of set, some sort of practices in place to prepare for this time where, rates are starting to increase.
Mhm.
So it's also important to know, regardless of what we're hearing in the media, rates are still at historical lows.
Yeah.
We just got very comfortable with unrealistic rates. So I think it's important to kind of see that. So now, if you're questioning that, let's look at some facts. So 2018, prime rate was sitting at 3.95. And the fixed rates were hovering, and these are posted rates, are always rate specials available, around 5.34%.
What I think is also interesting about that is that was right after the Wynne government had their affordable housing, and the government was trying to do the same thing that they're trying to do right now, which is slow down the housing market.
Correct. Put pressure on affordability. Yes,
Yeah.
absolutely. And so, but I was surprised looking at this because we got comfortable over the last few years with these historically low interest rates, and we got comfortable, and they're not sustainable. But once you start to look at historical data, it helps us really understand that it's inevitable that rates are going to increase. The pace at which that they do is a little uncertain, but there's still opportunity in the market. And I think that running these numbers with clients, sharing this information, hopefully brings a sense of sort of comfort as well. The other sort of key component is oftentimes that when clients see, the Bank of Canada increasing rates, they're wondering, how is this going to impact me today? So it's important to understand your mortgage contract as well. There are lenders out there that have a variable rate product where your payment is locked in. So your payment itself stays static. However, if there is an increase to the rate, which does impact the interest rate you're paying on the mortgage, you have more going to interest versus principal, but the payment itself is locked in. Now, should you decide there's been an increase to rates, you want to make sure that there's a balance between principal payment and interest, you can always call your mortgage lender and choose to increase your payments if you opt to. From an affordability standpoint, if you're just comfortable continuing to pay what you are, the impact will be on your amortization on the mortgage. It's going to take you a little bit more to pay down that mortgage, but it still gives you that stability if you're looking for that static payment. But there are other mortgage lenders out there that will immediately have the payment impacted by any change to prime. So it is important that you also take some time to really look at the mortgage product you've secured, completely ensure that you're understanding what your options are, and so that you're aligning those with your overall goals as well. It's also important to understand the numbers behind these increases. So we did see a significant increase on April 13th. But what does that mean in terms of dollars and cents? And I think this is where I think there'll be a sigh of relief. The overall impact is $26 per 100,000 in mortgage debt per month. So assuming you have a $500,000 mortgage, that's added interest of $130. Now, clients that are concerned about affordability, I think we're also overwhelmed because over the last few years, I don't think our spending has been realistic. We've been at home, less options, things are opening, we're spending more. Those that are having to travel back into the offices are starting to see expenses rise, and now mortgage rates are on the rise. Well, we as professionals are here to put budgets in place to help you make smarter decisions. That may mean curbing some additional expenses, giving up those 2 Uber meals a month to kind of offset this added increase to interest. But there are strategies in place and there are products available that can support you. And if you're looking to enter the market and you're concerned about rates and affordability, because that in order to purchase a property, you're aiming for a certain sort of price point, a variable rate product with a lender that allows you a static payment may be the solution. So we can actually help you identify a product that's going to match your goals. And those that had questions on renewals as well, and that may have a low rate and have a mortgage coming up for renewal, we also have the ability to look at your amortization and play with that. And what we might do is extend that amortization for the renewal, just to ensure that your minimum payment requirement is within your affordability, to give you that sense of peace of mind. But then I'm going to come knocking every 3 months saying, are you ready yet to accelerate that, put a little bit more? We're not going to leave you alone. We're going to ensure that we're still working towards your long-term goals. We're also going to be able to balance that with giving you that sense of stability and putting you in the driver's seat on your mortgage decisions.
Which is what a consultant does, right? This is why we love you, Rakhee.
Oh, thank you. So when we're looking at fixed rates are not necessarily impacted by the Bank of Canada. They're impacted by bond rates. So as bond yields rise, the fixed rates rise. So those that are seeing a significant spread between the variable and the fixed rates are wondering, which product do I opt for? The fixed rates have an advantage of giving you peace of mind because now you have a fixed payment and you have the ability to know and confirm a specific interest rate for a period of 5 years or the specific term that you are securing, but you're doing so at a premium. So it is important to understand that the fixed rates are always going to be sitting higher than the variable. With the variable, there is that interest savings, but there's that element of risk as well that you're taking on. Now, when clients come to us with that decision, it's a very it comes down to an economic sort of decision for us as well. So we're looking at the financial background behind that. So for example, currently what we're doing with clients is looking at where their fixed rate would be sitting and where their variable is currently sitting. Because with a variable rate product, you can choose to go fixed at any given point in time. Now, in full transparency, the lender is going to offer you the current fixed rate offering. and that can sit a little higher than, the lowest market rate. But we're going to actually calculate the spread between. So for example, today, if we're looking at interest rates, and we can use my example of a rate of 2.2, and with fixed rates, for example, sitting closer to 3.9%, that's a difference of 1.7%. I'm willing, given that spread, even with everything we're hearing from economists, it's going to be some time before we see 7 increases. I'm willing to wager for now, in my specific set of circumstances, to stay variable. However, if you're sitting with a variable rate product that might be half the discount, or where that spread is a little bit more narrow, maybe you're sitting at a rate of 3%. And fixed rates are sitting at around the 3.9 mark. It may make sense for you to potentially lock in, but there are other considerations as well. Are you planning on or intending on moving anytime soon? Do you anticipate needing to tap into some of the equity in your property in the next few years for any reasons? Because with a fixed rate product, it gives you that sense of stability and predictability, but it also means higher fees and penalties should you need to make a change. And these are overall costs. So outside of just the interest costs you're paying on a mortgage, you also need to consider these additional sort of prepayment privileges that you may have and additional sort of penalty considerations, because you need to ensure that your mortgage contract is also matching your life goals over the next few years as well. So there are other elements and other important sort of details that come into the equation when deciding what product to select as well.
That makes a lot of sense. And that's something that I go over oftentimes with our sellers. When we're getting prepped and ready, I want to know what the penalty is to break their mortgage. And depending on what point you're at within your term, especially if you're in a fixed rate, the penalty is significantly larger, especially on a bigger mortgage, than it is for a variable. So, I think that's something that when our clients are considering selling, or when they're at the point where they're looking to renew their mortgage, it does make a lot of sense to have someone like you who's asking them like, hey, how much longer are you going to be in here, so that we can kind of factor that into their long-term goals as well, so they don't get hit with a big penalty when it's time to trade up to a larger property.
Is the penalty for variable you're just paying, how does it work again? You're just paying the interest on it, or if you want to break it?
So if you're breaking a variable rate mortgage, it's 3 months interest penalty. And if you choose to stay with the existing lender, they will waive that. So should you decide that you need a new mortgage, or you're looking to tap into some equity, you would be able to do so and have those penalties waived. So it gives you that added flexibility as well, which I think is important. And anybody that might be, holding an investment property, we will often encourage the variable rate product for the sheer reason that your only tax-free asset really is your primary residence. So I will often encourage clients that have investment properties to tap into that equity, right, every few years, right? You want to be able to take that out, whether leveraging it towards purchasing another investment property or taking it towards paying off your home, right? You want to keep the weight of the mortgage on the investment property for tax purposes. The interest component becomes the taxable write-off. So the variable product can be the right fit for the right set of circumstances, and obviously taking risk tolerance into consideration as well. Now, with fixed rates, there are options available to clients that they can into their mortgage contract when selecting a fixed rate product, and that is portability. So I just want to make sure that we're offering clients as much education and options as possible. So if you are looking at a fix and you're anticipating a move, how does that work? How can we potentially avoid these penalties? You could take the mortgage and move it to the new property. For example, if you're choosing to sell and purchase a new home. What the lender will do is they will offer you these additional funds, usually at a little bit of a higher rate. So I think it's important to know that, but you could avoid those penalties. So there are options and workarounds if you are anticipating a potential move, but a variable rate will give you that added degree of flexibility. And again, the answer is different for every individual and their specific set of circumstances again. Now, Catherine had a great question. She's here with us today, and she had, prior to us starting the presentation, put a question out there in terms of us addressing what happens if you have a renewal that's coming up. How will you be impacted with these sort of rising rates? And we did take a moment to address that, and I just want to recap that. So the first, piece that I think is very important is to understand that you do have the ability to hold a rate up until 120 days prior to your renewal date. So I think it's important to take a proactive approach, pull out your mortgage contract, look at your last mortgage statement, refresh yourself on what that date is, and then, backtrack that. And then connect with either your mortgage broker or your banking specialist to understand when you can begin holding a rate and start that process early. Now, for those that might be concerned that, that window or that, time period is a little bit, beyond that 4-month period or 120-day period, we can run a cost benefit analysis for you. We can, help you assess what would the penalty be to exit that current contract to lock in a rate today. And you may opt to do that today for that peace of mind, or to ensure that you're able to now hold in like a lower rate for a period of 5 years. We do know rates are going to continue to increase. That I can say with certainty. That's one thing I think we're all aware of. So we can run that cost benefit analysis for you today. And you might be surprised by the numbers. You may realize that that penalty amount is minimal enough to actually take on the new mortgage and lock in for 5 years today versus waiting. So there are options available to you should you decide to do that, prior to the renewal date. But you do also have the ability to lock in a rate 120 days prior to.
Which should definitely give people peace of mind if they're concerned and there's talk in the, talk of future rate increases.
Correct.
Makes a lot of sense. Yeah.
So those that are concerned about, the increase to, the overnight lending rate and the prime rate, I think it's important that we all have an understanding of how do we calculate our net rate. We become so fixated with the increase. I think it's important to kind of take a step back and really look at our mortgage contract. So I run some very simple numbers. After the March increase to prime, my rate was sitting at 1.7, which was still a really great rate. So I wasn't concerned. I opted for the variable. I knew rates were going to go up. So I ensure that I'm being mindful of what I'm hearing, and then I'm ensuring that I have an awareness of where that rate is sitting. Now, April 13th, we saw another increase, and my rate did shift and change, but I'm still very comfortable because I still know I have a very great rate. I have a good rate, and I'm comfortable with what I'm paying. I also opted for a mortgage product that kept my product static, like my payment static. So I'm comfortable with predictable payments, a low interest rate. However, what I've chosen to do is set my payments as if I'm paying a 3.2 rate today. I've increased my payments, and that additional amount that I'm paying is going to pay off my principal that much faster. So again, we're happy to put a strategy in place for you. I truly believe, like my mantra is how you live your mortgage is how you live your life. So we're really here to support you in devising a strategy that's really specific to you as well. So again, where are fixed rates sitting? They're sitting at around that 4% mark today. And the difference in payment and interest is $26 per 100,000. And those that are wondering, well, if it's a 1/4 point increase, because this was, it was the first time we saw a 1/2 point increase in over 22 years, I think it's important to understand that generally speaking, historically, we've seen increases of a 1/4 point, and that in turn has an impact of $12.50 per 100,000 in interest. I think just breaking down the numbers makes it a little bit more digestible and takes away that sense of panic.
I totally agree with that.
So again, we're happy to address any questions. Hopefully everybody's populated their questions in the chat box, and I'm happy to take a moment to address. Okay, perfect.
Awesome. Thank you, Rakhee. I know I don't know as much about mortgages as we do about selling real estate. So, I mean, that's why what we rely on you for. Thank you so much. David, would you mind reading out some of the questions that were submitted? Not to put you on the spot. He doesn't love the spotlight. So
yeah, or I'll type them in the chat.
We like to hear your accent. No, he's not playing.
No, you know what? I was really nervous just about when it went up, like with obviously my own mortgage. And then you just breaking it down with me, Rakhee, and like explaining to me that how minimal it actually is, and because I guess I pay bilaterally, biweekly, accelerated biweekly, how it, I know bilaterally, that doesn't make sense. How everything really just stayed the same.
For sure. As soon as we looked at the numbers, it was a really easy decision to decide what was best course of action in your specific set of circumstances.
Because my monthlies are what I have to be careful of, right? Which is what most people, like even with clients, that, you know, they give me a price range and I always say, do you have an amount that you kind of want to, you know, what's your mortgage amount that you want to keep monthly? And usually that's how we figure out a property for them.
For sure. And if you don't mind me sharing, what we discovered when we ran your numbers is that your net rate had fallen to 2%, which is still a really great rate. And with that rate, you had a significant portion every month or every biweekly payment going towards paying down the principal.
Yeah.
And when we looked at the numbers of maybe locking in on a fixed, it was on the other side of the scale. We were putting more towards interest.
Yeah.
Versus principal. So and Nikki, in your specific set of circumstances, as soon as we looked at the numbers, it was easy for you to establish what was best for you.
Yeah. And I went from what, 1.35 to 2. Like it was a pretty scary jump when you hear it, but it worked. So yes.
Okay.
Questions.
Yeah, so one was, do I prioritize paying off my mortgage or invest in another property?
That's a great question. And I think this is one that we'll have to answer, I think, as a team. And this is really where there is opportunity costs, right? And this is where clients that are looking to refinance or leverage equity that they've built, because we've seen healthy appreciation rates as well over the last few years. So there's opportunity. And clients are wondering, do we keep that in our home or do we potentially take that and potentially use it towards an investment? Or if we're sitting on savings, do we take that and pay down our mortgage? Or do we take those funds and maybe look at potentially, purchasing an investment? And that's where I think it's important to take that information and look at historical data with real estate appreciation rates. Talk to Nikki and Steph about opportunities in the market, because I think there is opportunity today. I am encouraging that with clients. I think there is opportunity. So we have to look at, cost of borrowing, and we have to look at the opportunity and returns of maybe taking on an investment purchase or taking those funds and investing, and then running those numbers to see what's best for you. But I do think that there's opportunity. Rates are still at historical lows. We looked at historical data. I think that just kind of reconfirms that there's still opportunity in the market to take those funds and put it towards an investment that's going to yield you a higher rate of return.
Well, we have a client right now who literally just refinanced. She's been in her place for, I think, 3 years, refinanced, took 200 out of her place, and she's now buying an investment property. And we've done it so that the rent is fully covering the rental property. So yeah. It's just, and for her, she knows she's probably going to be in her condo for another 3 to 5 years, but it made sense for her to take her equity and buy another place and have an investment property, because rental prices are still so high. So it's working out.
I think, the analogy is, when is the best time to plant a tree? 20 years ago, but the next best time is today, right? And real estate, it's not day trading. Like it should be a long-term investment. Mm-hmm. And our, interest rates, even at 2, 3, 4%, they're still really, really low. And if you can get it, most of our clients have to put down between 25 and 33% based on the current rental rates for condos, if they want to break even. Or have a little bit of positive cash flow every single month. But as Rakhee had alluded to earlier, you can write off your interest. You can write off our fee to help you find a tenant. You can write off the repairs. So you have a property that the tenant is paying for you. You're not paying anything to carry this property. And then you have the price appreciation. So far this year, downtown year over year, we're at about 27%. They were forecasting about 10.5% year over year, but the economists now that, you know, everything they've seen the data for the first quarter are saying it's going to be about 15% year over year by the end of the fourth quarter. So there's not many investments where you're going to be able to put down 20% and have the entire, like 20% capital, and then the entire purchase price of the property appreciates 10, 15, 20%, right? We can't guarantee that we're going to have another year like we have the last few, but even if your investment's going up double digits at 10% for the next couple of years, that's a lot of money. Like, that's a good investment for a very low investment of funds. And most of the time people have that money that their current property has appreciated. So, I mean, I think it's a case by case, but I think that we can make a pretty good case for why it makes sense to consider it, at least if you have the equity or savings.
Absolutely.
What else, David? What else we got?
When will rates decrease again? Is it worth waiting before purchasing?
Did you just laugh, Rakhee?
If I had the answer to that question. I think that if the economy continues to rebound, this is healthy. I think rates are resetting to a healthy level. And I think I think it was unrealistic to assume that we were going to have rates continue as they were. So I don't know if we will see a change to the interest rate environment. The government responded when we were in a very sort of delicate situation with COVID, and many households were being significantly impacted. I think we're coming out of that. Things are starting to rebound. So in terms of when rates will fall again, I can't address that for you, unfortunately. But I think that we need to just be realistic that where rates are kind of in line with historical data, and there's opportunity today. And I think if you're looking to, renew or lock in, there's opportunity today to still secure a very aggressive rate.
Would you agree as well that if the economy in the world is going well, usually interest rates are a little bit higher? Like, I remember in 2008, when I had first bought my property, the US was having this subprime mortgage meltdown. So when the government wants to stabilize the housing market and to increase the economy, like stimulate it, they lower interest rates. And when they want to see things slow down a little bit, it's the opposite. So I mean, I think it's a good sign for the economy as well, that interest rates are increasing. As much as it sucks, to see your interest rate go up by 0.75, as Nikki had said.
When you break it down, it's not as scary.
Exactly.
Yeah. I think that question is similar to when people ask when prices are going to come down, if they should wait to buy, right? Because you never know. You don't know when the top of the market is until it's on its way back down.
You only know now.
Yeah. It's you don't know until it's already shifted, right? So it's one of those things.
Next question.
Any other questions, David?
Yeah, one was, I think you may have already answered it. Would you recommend locking in a variable rate mortgage now before rates increase further? And what percentage, either up or down, is this rate hike expected to impact home prices?
So this is a two-part question.
Yeah, it's a good question though.
It is. It's a great question. So in terms of locking in on a variable, again, I'm going to, reference some of the slides. It's going to be very specific to your personal risk tolerance. Is a property that you're considering, securing a mortgage for an investment, or is it in your owner occupied? What are some of your concerns? Is it, keeping a static payment? There are options available. And yes, there are some still very aggressive rates available on market. And it's really just ensuring that we understand your specific set of circumstances, your goals, and align that with both information on what's available to you on a variable versus fixed, and running that analysis to help you decide what's best for you. So happy to do that. There is opportunity in the market. You know, lenders will lead with their rate specials in a spring market. We see that, you know, at this time of year, every year. So there is opportunity in the market, and we're more than happy to kind of address and connect one-on-one to give you that insight and help you make that decision. In terms of impact on the market, I'm going to hand that question over.
I mean, I think it already has had a little bit of an impact, but I think it's more the fear, which we typically see all the time when this happens. But honestly, give it less than a month, and I think it's all just gonna come back.
All before the storm.
Yeah, always. It's the April slowdown, and then it's just gonna whoosh.
I think, you know, we'll have to see once the dust settles, because I do think that we were starting when they did the first increase. Like, listen, the point of these rate increases were to slow things down. The government is intentionally trying to do that, and it is going to have an impact. Buyer sentiment definitely impacts what happens with sales. And, you know, because I focus on listings on our team, I'm always looking at absorption rates and inventory, and we are starting to see inventory creep up a little bit. So, you know, the crazy surges in the housing market have definitely been fueled by supply and demand and a shortage of listings. And as we start to see listings taking a little bit longer to sell and sitting on the market, you know, obviously that will bring prices down a little bit, or at least level it off, but we're still sitting in a seller's market. I think we have about, in the downtown area where we're focusing on, like the downtown core, I'm still only seeing about a month's supply, or less than that in most areas, of inventory. So until more listings come on the market, pricing won't come down. I think a lot of people that had already bought something and were really nervous and concerned about whether, like, I think those people sold for a little bit lower than they could have. But we have a lot of clients that have a lot of equity in their properties, and anyone who's an investor and doesn't have to sell for a lower price, they're just going to take their property is going to sit on the market, and they're just going to take it off the market. The only people that are going to sell for a lesser amount are really going to be the people who are nervous. They've already bought something, they're being transferred, a divorce, like any of those situations where they have to sell for a lower price. Everyone else will just kind of wait it out a little bit and see where the dust settles.
I also think it's a change strategy. Like, Steph, it's something you and I have talked about, you know, multiple offers versus listing your place, offers anytime, as they say. And I've noticed that obviously in the last few years, it's multiple offers have just taken over the city. But I have noticed in the last 6 weeks or so that that's shifting. And it's almost like this has also caused a change in the strategy. We're all reading the question that just came in.
Yeah, no, for sure. I mean, and we'll answer that in a second. I do, you know, most of our first time buyers had a hard time qualifying anyway. So if the interest rate goes up, it's not like it's going to, like, they already were having a hard time qualifying at the lower rates or based on their income for the amount that they needed to secure the crazy prices that we have downtown. A lot of our first time buyers were already securing funds from the bank of mom and dad in order to be able to qualify. So I don't think that's going to change. So $26 for every 100,000, not really going to have much of an impact there. And a lot of our clients that already own property, they have tons of equity from the last couple of years at 27%, 15%, 10% growth year over year for the last few years. So they are just taking that equity and rolling it in, even if their incomes have stayed the same. So, you know, I think even if rates get up to 5%, I don't see that really having enough of an impact to really slow the market down. That's just my opinion. Like, if things get up to like 10%, yeah, okay, that's a different story. But, you know, the thing to factor in too is even if interest rates go up by like another 1% and housing prices come down by 1%, it evens itself out. Like, you still have the same payment amount. So I don't really see this at this point. Yeah, I don't see this at this point having much of an impact. I mean, I think it will make people a bit nervous and they're going to wait and see. But even when we've had these decreases, it happened in 2008, it went down 5.5% over a 6 to 9 month period. And then it turned on a dime and went up 15%. And the same thing happened with the condo market during the pandemic. They said it was going to go down 20%. I said, never a chance in HELL that that's going to happen. Sure did. But guess what? That was a 6 month blip, and then it went up 27%. So, you know, I think when we do have these corrections, they're very short lived, and the rebound is kind of unfortunately epic on the back end of that. So, you know, you always, if you have a graph, it's like there's a straight line and the unlucky people at the top and then the lucky people at the bottom. And it's really almost impossible to time it, if that makes sense.
Okay.
Did you want to answer Tori's question? Thank you for sending that.
And it's
This
not
may be
a
a stupid question, but does owning company shares increase how much you can loan?
Unfortunately, lenders will establish your overall sort of loan exposure based on the income you're declaring. So unfortunately, the share component will have a net impact on what you're drawing from the company, and that will impact, you know, the overall income, which will impact the overall loan exposure. So it does come down to the net income that you're showing, and not necessarily the share piece of the equation. But happy to also address that, you know, one-on-one as well.
Yeah, I know that you guys have special products for, you know, people who are self-employed and in kind of different situations like that, to make it easier for us to be able to secure, you know, different products for financing.
For sure. And we've seen some really great new products as well that are being offered by insurers, where we can look at business bank statements to qualify clients for mortgages. So currently there are more options available for self-employed. So if you are self-employed and, you know, you've had more challenges in the past, there are shifts in mortgage products today that offer clients with a fair amount of flexibility and options today as well. So I do want to encourage that. You know, we're self-employed, so we understand the challenges, and there are options available to you. So don't shy away. I think as self-employed individuals, we often hear of the challenges, and that can create some anxiety and stress, and we can eliminate that for you. There are options available. It's just a matter of connecting and understanding how we can match the best product to your specific set of circumstances in terms of how you're declaring your self-employed income.
I've seen Rakhee do miracles.
Ah.
I actually, I had one of my clients text me. He unfortunately isn't able to make it, but he was asking if I could ask you, sure, is there a certain limit to how many mortgages somebody can have? So he currently has 1 primary residence and 2 investment properties. He's looking to, again, take some equity out of his primary residence now that it's increased. And he is wondering if he can go through a regular lender, or kind of what you would look at for him for his situation.
Absolutely. So there are options available. Lenders can sometimes have an appetite where they don't want to see more than 5. If you're looking to work with one of, you know, the big banks, they generally will cap at about 5 properties. Yeah. However, as brokers, we have access to multiple lenders. So there's always a solution for every client. Now, any institution, meaning a bank, is going to look at the income to carrying the property and being able to debt service the principal, interest, heating costs, and property taxes. And we can always incorporate some rental income if the purpose is to secure the property for the purposes of it serving as an investment. So again, typically the banks like to cap you at about 5. However, on the alternative side, we have access to lenders that can support well beyond that.
How much of the rental income will they look at?
Each lender is a little bit different. Typically, if you were to ask me, it's about 50% of the rental income. There are lenders that will use what's referred to as an 80% offset, or a DSR ratio, where it's basically, are we sitting in a surplus or a deficit, and then we can do an add back. So lenders have there are various lenders that have different policies in terms of how they will utilize the rental income component. So there is flexibility as brokers to ensure that we're matching the best product to your financing requirements, right? Because also matching that budget to what the market will yield, because we do want to help you get into especially when we're looking at investment purchases, something that's going to yield you the return that you're looking for as well in the long run.
Yeah, that makes sense. Awesome. David, do we have any other questions?
I think the last one you may have already covered. So it's, how does refinancing work, and what is the difference I'm paying for a 50 BPS difference in rates?
For a what?
50 basis point different.
So we established that as $26 per 100,000. So that's the quick calculation that you can use. Next Bank of Canada announcement is June 1st. So just to ensure that, if you're concerned about what may happen or what's coming, I wish I had that crystal ball. Unfortunately, we don't, but we can break down those numbers. Typically it's a quarter point, and that would be $12.50 per 100,000. So hopefully that, sheds some light. With respect to refinancing. So refinancing is where you're looking to take your mortgage and increase it, and take some of the equity that you may have built over the last couple of years. As Stephanie was referencing, we've seen strong appreciation rates, 22, 25, up to 30% in some areas. So if you built some equity and that you're sitting on that equity and you're, contemplating maybe taking some of those funds for renovations, or taking some of those funds to address some debt that you may be carrying. Maybe, you're holding a home equity line of credit that has a sizable balance on it, and you're looking to maybe, consolidate that into your mortgage and have a lower fixed payment. That is considered a refinance, or tapping into equity that we can put into a down payment on a new investment purchase. We would then collect your information, meaning your income documents, information pertaining to the property, assess the current value of the property, and educate you on what you may be able to access from the property. And that's referred to as a refinance. And that's contingent on ensuring that you have the ability to demonstrate to a lender that you have the ability to demonstrate the income to debt service and carry those payments.
Another question.
Mm-hmm.
I'll read it. Since I'm self-employed with an incorporated business, if I were to raise my salary to get a bigger loan, how many months of pay stubs paperwork do I need to have with the new salary, if that makes sense?
That's an excellent question. Yeah, so if you are self-employed, a lender is going to want to reference your last 2 years tax returns. So if you are incorporated and you are drawing a salary from your corporation, the lender is going to run a 2-year average of your net income. But as mortgage brokers, there are lender programs available where we can take that 2-year average and also apply a gross up. So if you are looking to get into the market today, it is important that you start early with connecting with a mortgage broker. We're here as consultants. We're here to help you demonstrate the income needed to hit some of those sort of purchase goals and mortgage qualification goals. And we can educate you on, standard programs, alternative programs, and help you find that ideal solution. But if you were to just simply increase your income over the over the sort of the next few months, that isn't sufficient enough to demonstrate to a lender the consistency with income. They generally want to see a minimum of 2 years of history.
Yeah, that's a good question, because I know Nikki and I both just incorporated last year and started paying ourselves a salary. And that was one of my concerns is, if I'm paying myself a salary, which is a little bit less now, to keep funds in the corporation to have a better tax rate, how is that going to impact my ability to secure a loan? So I think that's a great question. That's why I didn't want to pay myself too little, because I wanted to make sure that if I want to buy an income property, like another one this year, that I have the option to do that.
Sorry, I'm just gonna drop. I'm sick of typing, but yeah, that's exactly the same type of situation. Like, money's there, I don't want to give myself too much so I can keep more into the business. But
Yeah.
for the sake of getting a bigger loan, like it's possible, you know what I mean?
Mhm.
Yeah. Well, you can also, I mean, you can also draw on it and
Yeah, because
pull
you only
some.
get taxed one time when you take it
Yeah.
out. You could do that when you need just a larger down payment.
Mm.
Okay, yeah. Mhm. Thank
Well,
you.
then it counts as income for that year, but yeah.
Oh, I see. So that would
Mhm.
be essentially a bonus added on the salary.
Yeah,
Talk
like you
to
get
your
taxed,
accountant.
you get taxed on it.
Yeah, talk to your accountant because Tori, I literally just had to change my salary.
Mhm.
And he said too, like how I did it was it's almost like a bonus.
Mhm. Yeah,
Like
I
you
did
give
speak to my
yourself some
accountant.
type of bonus.
Yeah, it's you got to claim it as a bonus with taxes rather than a dividends.
Yeah.
Something along those lines.
Depends how you structured it. I was to my accountant, I was like, great, you figure this out.
The
This
same
is what I
accountant.
wanna
It's the same accountant.
Yeah. No, he's great.
So that's
He's
what he
great.
said.
Yeah. Awesome. Does anyone else have any more questions before we wrap it up? Any more burning questions?
I had a lot of people message me before just saying like they either had to put their kid to sleep or something with
Yeah.
work or something. So I know that we had I think 34 people sign up, and I had actually a few people just before be like, so I know that we will be sending the
The
recording.
recording.
Yeah, because I had a lot of people just say like, is this being recorded? Because I'm so interested. I just, life.
Mhm.
Yeah, with schedules. Well, I think I speak on behalf of everyone, just saying, Rakhee, thank you so much. And for everyone who attended, thank you. As we mentioned, we will be sending out the recording. We'll have our contact information. We'll have Rakhee's contact information. So if anyone has any more questions about the real estate market, about buying an investment property, the value of your property, refinancing, or securing a new mortgage, looking into the different products. And as we said, potentially locking something in ahead of time, we're more than happy to help. So feel free to use this as a resource. Thank you, everybody. And if there final last call, if there's no other questions, we'll sign off. Rakhee, if you have anything else that you want to add.
No, thank you for the opportunity. And if anybody has any burning questions that are specific to them, more than happy to address those as well.
Wonderful.
Thank you.
Thanks,
Yeah.
everybody. Have an
Thank
amazing night. Bye.
Okay.